Fiverr just reported their latest earnings report. At the time of making this video, the stock is down 8%. The market open. The company has a market cap of under $1 billion, has a forward PE of 11.3 times, and EV to sales in the next 12 months sits at 1.7 times. Now, the big issue here was not the fact that the company is actually profitable. It's actually a solid quarter, but guidance was a complete miss for Q1 and for full year 2024. Basically, you're not really buying much growth. We're going to have a look at the numbers in just a second. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, I do want to make it very clear, I still have my small position in Fiverr. I'm really on the fence right now whether or not I want to continue holding my bag or sell it and put it into something else. Of course, whenever I'll do a move, I'll let you know beforehand. So, fourth quarter results. Revenue increased 10.1% year over year to $91.5 million. Active buyers are actually down 5% year over year, and I believe quarter over quarter as well, from 4.2 to now 4.1. Spend per buyer did increase 6% year over year to $278. You might say yes, but that's because active buyers are down, and so you can pump those numbers up artificially a little bit. Yeah, there is a mix of that, plus going up market. A bit more on that later on. Take rate, still very, very impressive here, 31.8%. That's up 160 basis points year over year. Gross margin on a GAAP basis, 83.1%. So GAAP net income, $4.7 million. Adjusted EBITDA of $16.1 million. And adjusted EBITDA margin of 17.6%. Still far from their end goal of around 25% or so. But again, you're buying here a company that, well, wasn't really profitable before. Now it's showing, yes, we can be profitable. Very, very strong balance sheet as well. But the problem here is growth. Q1, they expected to grow 4 to 6% year over year. Market was expecting a bit more than that. Adjusted EBITDA to come between $12.5 and $14.5 million. And then for the whole year, growth of between 5 to 7%. Again, market was expecting more. This is obviously a thing that we've seen with other companies as well. Companies that have been performing quite well a bit before the pandemic, through the pandemic, and even just after the pandemic as well. But then after that, interest rates are extremely high, economic uncertainties, macro difficulties, and so they struggle to continue to grow. Now, there are some companies that don't grow and are unprofitable. That's even worse. Fiverr in this case is not really growing much, but at least it's profitable. So at least you're getting that. But moving forward, I mean, when you're buying Fiverr, for example, you are expecting it to grow, right? We've discussed in the past the huge total addressable market. So yeah, going up market, even staying in their own segment, which is lower end, there's still some way to go. So something here needs to give. Currently, there's no light at the end of the tunnel. Continuing here, as always, they're increasing return on investment for performance marketing investment as cohort season over time. As they say here, as of December 31st, 2023, revenue from Q4 2020 cohort reached 3.6x of the initial performance marketing investment in Q4 of 2020, representing an attractive 3-year LTV to CAC ratio. They say here that the percentage of core marketplace revenue coming from repeat buyers was 66% in 2023, up from 63% in 2022. They were able to drive more of their business from repeat buyers given the stable cohort behavior from their existing user base. Now, as with going up market, this has been a thing for the last 2-3 years or so, and I'm yet to see really a huge impact from that. I was very excited when they announced going up market being a bit more aggressive there, which means that spend per buyer should have been going up quite a lot. Would also mean that the business would be a bit less reliant, let's say, on individuals and more reliant on companies. Right now, I'm not really seeing the full effects of that. They say here with regards to spend per buyer, the average spend per buyer for the 2023 cohort is 13% higher than the average spend per buyer for the 2022 cohort in the first year. They also saw buyers with annual spend of $500 or more grew 4% year over year, significantly higher than the overall active buyer growth. Again, great, but this is no growth number. 4% year over year is not much. Now, with regards to spend per buyer, monetization rates, stuff like that, they did say that spend per buyer has gone up, active buyers has come down. They're using the same, I won't say excuse, but explanation, saying that they're going to attract higher valued customers that will be with them for longer and spend maybe more as well, rather than the one that will just spend $5 once and that's about it. Could be an explanation, could be an excuse. Now, with regards to monetization and take rate, they say here with regards to promoted gigs, as a result of all the efforts, they were able to grow revenue for promoted gigs by 80% year over year in 2023. Seller Plus revenue grew over 2.5x in 2023 compared to 2022. We believe both programs still have plenty of growth runways, although the pace of growth will moderate in 2024 in comparison to 2023. As we've seen with plenty of companies, 2024 does seem like a reset year. With regards to AI, so double-edged sword for sure, right? AI could drive them out of business, but AI could add a lot to their catalog, a lot more demand. And that's exactly what has been happening. They say here that as we look back at 2023, they estimate that AI created a 4% uplift to their business in 2023 as they experienced the category mix shift from simple services to more complex services. They estimated that 32% of their GMV came from complex services, up from 25% in 2022. GMV from complex services grew 29% year over year, a significant acceleration from 12% year over year growth in 2022. They also had a negative impact with regards to the NFT market. Of course, NFT was very, very hot back in late 2021, 2022. NFT markets were blowing up, then completely died down. They say here that experienced a 80% decline in GMV from 2022 to 2023. Now, moving forward with regards to AI, I just want to say one thing. I know there are a lot of AI applications that make it extremely easy to do things that you couldn't do before, or that you went to Fiverr to ask someone to do that for you. But do not underestimate how lazy people are. More people are probably inclined to just pay a certain amount of dollars, tell someone to do something for them, and that's it. Of course, there will always be a chunk of people that will like to do it themselves now that it is a bit easier. But overall, I do still think that this will add a bit more demand than that it will remove. Then a bit more color on the financial outlook. So they expect to accelerate GMV growth by 1 to 2% as they continue to invest in progressing upmarket and complex services. Take rate is expected to expand at a more moderate pace in 2024 compared to 2023. Spend per buyer is also expected to accelerate in terms of year-over-year growth rates, and active buyers to continue to maintain similar trends as in 2023, which means basically doesn't move or goes down. For adjusted EBITDA, they expect to expand the adjusted EBITDA margin at a steady pace and continue to make progress towards the long-term target of 25%. Overall, they expect to take a balanced and measured approach in driving profitable growth in 2024. And so if we look at the graph right now, this is on the daily. Green candle, by the way, today, despite that gap down, which means there were some buyers at under $23, which might be a little positive sign. There is still some interest with regards to Fiverr at these prices. But overall, I think it was pretty clear that rejection here at 200-day moving average back in February was maybe a sign of worse things to come. So overall, to conclude, still holding the bag here, still holding a company that is not really growing that much. It is profitable, so at least there is still a lot of potential, but I would still love to see reacceleration in growth. Until then, I'm not planning on adding any extra dollars. Maybe when interest rates will come down heavily, maybe growth will reaccelerate. Maybe they'll spend even more to attract highly valued customers. Remains to be seen. Overall, that's my thought. Of course, do share yours down in the comments below. If you enjoy these type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.